I mean, how often can we talk about diamonds and wine and art and call it work? So, as a fund of funds investor, I think one of our big mandates is to consistently search for different investment strategies. And today, I think that search is even more important than it's ever been, because if you look at the last 5 years or so, hedge fund strategies have really become more and more correlated. I think if you look over since 2008 or so, it's a 0.9 correlation or so to the S&P. So to find diversification in your portfolio, you have to really look further and further and further afield. And why do you guys think alternatives are relevant? Why don't we just start right down the line?
I start with low correlation. Our works have a very low correlation with traditional investment assets. Some of our categories are even negatively correlated with financial indexes. Another one is diversification. According to the May Moses Art Investment Portfolio, according to the May Moses, which is an art index, by the way, we have art indexes that measure the performance of the industry as a whole. And May Moses is one of them. There are various. According to them, an investment portfolio diversified with artworks will have between 10 and 20% lower risk than one without art. Another one will be low volatility. While stocks can suffer double-digit losses in one day, the art market exhibits far more stability even in economic turmoil. Well, in 2008, this is an interesting data, the SP 500 collapsed 37%. Correct me if I'm wrong. The May Moses All Art Index only fell 4.5%. Global market. It is an asset that can be appreciated and valued anywhere in the world despite the currency or economic situation, enabling transactions worldwide. Furthermore, the globalization of the art market allows for geographical arbitrage. Market arbitrage opportunities, the lack of organization or regulations within the art market produces very profitable arbitrage opportunities. Hedging possibilities. Art can be a very useful hedge against inflation and currency fluctuations. That is obvious if you own a Picasso, like the one you just showed, and you were just showing as a small painting. You can actually take that painting and sell it in any country and get paid in any currency that you want. No depreciation. Art is an asset that doesn't depreciate with time or use. Moreover, it will never be worth zero. Low cost of maintenance. Artworks can have a very low cost of maintenance compared to the return on investment that they can have, as opposed to real estate holdings, for example. And no taxes. Art appreciates tax-free and does not incur in property taxes like real estate.
Let's kind of step away from the canvas for a moment and be agnostic as to the macro environment and take two states of the world. One is highly inflationary and one is highly deflationary. I'm just curious how each of your approaches does in each of those states of the world.
Over the past, 50 years or so. Art is one asset, like I said before, where you can invest on it, and like I said, it's not going to depreciate for the most part. If you make a good investment, it's something that you can hedge against inflation. It's also a good way to protect assets. And you can actually store it anywhere in the world that you want. The cost of insurance and keeping $1 million of art, for instance, in our experience, is about $1,233 per million per year. So the cost of insuring art is almost negligible. So, having said that, you're not. If you were investing in other commodities, and other types of commodities, sometimes the costs associated with running your inventory and keeping those assets afloat. If you buy in real estate, for example, you have to pay real estate taxes. You have to pay maintenance fees. You need to allocate for funds for depreciation and repairs and whatnot. In art, all of that is minuscule. So that's why I say it's a good hedge against inflation.
Here, I'd be really curious. What are once we kind of get settled on what the beta drivers are, we'll go through it again and we'll talk about how you guys approach the asset class to actually make money beyond what someone could do passively.
for what I've listened through my colleagues here, there's a lot of similarities, again, in our industry. But there are also fundamental differences. And I think one of the fundamental difference, the biggest fundamental difference is that as opposed to perhaps wine, because you measure, you have some barometers to measure the value, or diamonds, which I think they also have their own scale of values. In art, as a commodity, there's one inherent risk which is very difficult to value, and that is an emotional asset. How do you value the emotional content of the asset? You can effectively price an artwork, and you can effectively price your portfolio. And we have one advantage in the art world, which is that we also have very effective art indexes valuing the entire performance of the is estimated about a $60 billion art market, of which more than 30% is exclusively in the hand of the auction houses, which I must say that the auction, one of the problems that we have in the art market is the high cost of transaction. You were saying before that sometimes it's gone through 4 hands before it reaches the investor in the art market. One of the biggest inefficiency in the market, I would say, is on an average, an auction house can charge up to 25% of the fair market value. And we define our inventory by fair market value. That is, we go out with our paintings, we give them to independent appraisals. They conduct a study, they looked at the market by comparison analysis, the same thing you will do with real estate. And you come up with a value. That value is fair market value. So if we decide to sell a painting in an auction, or we bought it from an auction, once the painting sells, we leave in a good amount of money on the table, which is what the auction house profits from. If you deal with galleries or other intermediaries, the average commission is about 10%. And we're also leaving a substantial amount of money on the table. So it occurred to me a while ago, and I was discussing with Enrique Lieberman, I think he's here, president of the Art Fund Association. Perhaps there can be a mechanism where we could subsidize a fund of funds, or put together a group of funds, because what the auction houses have is the ability to attract consignments. And we, again, we're a new industry. This is our 3rd year in operation, but we've been able to assess the ability of us to be able to consign a lot of works, and not consign, I mean, to get offers from the general public to us directly. We can buy those paintings, but then at the time, when the exit strategy kicks in and we need to sell those works, we're limited with the amount of works that we can place publicly. So perhaps we can subsidize through an insurance vehicle some kind of fair trading mechanism that will work almost like a stock exchange, where people could go and buy artwork paying almost no commissions, because it will be subsidized by investment funds. And that will give a lot more transparency to the industry. There's a lot of issues in the art market, such as the asymmetric information. It's a very specialized market. There's a black market out there also. It's a market based on trust and relationships. There's a lot of barriers to the entry, which actually, although they make the investment vehicle a little bit more difficult for an institutional investor. On the other hand, it can be played to the advantage of an investment fund. And the way we create value is we have several investment strategies, such as the acquisition at competitive discounted prices in particular markets. Anybody could invest in the All-Art Index. And last year, the All-Art Index had a return of 10.2% growth. But I can also tell you that in the last 50 years, the returns have been 9.23% compared with 9.73% for equities. So one could invest in the All-Art Index and not have the liquidity issues that an art investment fund will have. However, I think we can maximize the returns also by acquisitions and competitive or discounted prices, by geographic arbitrage, co-investments with third parties, showcasing the fund's portfolio at important museums, shows, and exhibitions worldwide, exploitation of market inefficiencies, and, like I said before, eliminated the intermediaries.
What do you think the kind of beta return over a, let's say, 5-year period is for each of your asset classes? And then what do you think and I'll frame up that, let's say the macro environment is sort of a normal environment, normal inflation kind of thing, right? And then what do you think the alpha is that you guys can generate in each of your respective strategies over and above that beta?
I would say that the beta will be somewhere between 9 and 10. And the alpha, I would say somewhere between 14 and 17%.
In your strategies, why don't we just give kind of one or two trade examples of things that you guys do that you think are really give the salient characteristics of the alpha that you're able to extract?
When we started the fund in 2008, we put it on hold until 2010. But we already had some funds we started buying in 2009. In 2009, the market had already collapsed. And it was a good opportunity to grab some good paintings from the auction houses. So we did buy a few of these paintings, and then, for instance, works by Orozco, Picasso, or de Kooning. And I'll give you an example. You all know last year there was a big retrospective of Willem de Kooning here at the Metropolitan Museum. So we knew that there was an exhibition at the Metropolitan from works by de Kooning, so we jumped ahead and we bought some works by de Kooning, and we got an average return on those paintings by almost 50%, and we were able to flip them in just about 100 days. Same thing with Orozco. There was also a major retrospective at the Museum of at the MoMA, and then at the Centre Georges Pompidou. So we loaned, we did buy some works ahead of time, and we loaned them to both the MoMA and the Pompidou. Right after the exhibition, we bought one painting for, I think it was $135,000 during the crisis in 2009. We sold it for $450,000 in about 200 days. So that was a short holding, and we had the same situation with a Picasso. That was a bigger investment. Well, actually, I'm not going to give the numbers because we still own it. I won't tell you my cost, but we bought that work effectively 3 days prior to another very similar painting selling at Sotheby's for $27 million, and our painting is just about the same size and painted 1 day before the one that sold at Sotheby's. But we were able to grab this painting just a few days prior to the sale. We knew the painting was going to be on the auction market, and we went ahead and bought it, and it proved to be a good strategy. But that we do with our work from very well-known and consolidated artists. You could actually get much higher returns in the art world if you want, but you need to take into account your risk-return tolerance. Because if you're risk adverse like we are, we don't invest in contemporary art, which is the category that gives the highest returns. You can have huge returns. And actually there are funds out there that do invest in contemporary, and then the returns can be up to over 20%. But of course, when the market contracts for any reason whatsoever, the first sector that gets affected is the contemporary paintings. And in our industry, every asset category has a different performance. All master paintings has slow growth, but steady. Impressionist and modern paintings, because of the rarity of the works, they give the highest returns. Probably most of our portfolio is allocated in that category. And then you have the post-war and some well-established contemporary artists that also have a different behavior. So the way we combine all of these categories to look for the place where we feel most comfortable, again, discussing that risk-return strategy.
Why don't we spend a minute or two just on the risks? You know, there's fake artworks and fake wine and fake diamonds and all sorts of other risks associated with it.
You know, Market, in terms of fakes, which would probably be like a big thing in the art world. In fact, there's a big industry, and in the United States is even bigger. I think it's just about $10 billion a year or something like that. But anyway, it's not like we can lower our guard, but it's not a huge concern. We have a very specific investment protocol, and through that protocol, which we go through that protocol twice, we have a whole valuation scale. The valuation scale is based on 20 points. and we give an average point to each one of the paintings based on rarity, condition, provenance, price, the wow factor. I like that one because it's like I said before, it's one of the things that are difficult to value. Wow factor is a good one. But no, in terms of fakes, we rarely we get offer fakes. I would say number one, because we can spot it quite easily. Second, we work with every main expert in the industry. So whenever we get a painting, we double check the certificates of authenticity. We have the painting reviewed by a conservator that's going to tell us if that is the painting we're actually buying. So again, in terms of buying a fake painting, I think it's a minuscule risk. Where you will probably find more risk is if we would make a mistake in assessing the value of the painting. And that can happen. Generally speaking, again, we go through, first we have our first due diligence, where a group of people within our fund, we sit down together and we do our first run of analysis, and we decided we're going to pass that painting to the second run. And we value the painting twice internally, and then we send it to experts, to expert appraisals away from us that will give us another clue on the value of the painting. But you can have, for instance, I would say, let's say, for instance, you can have a painting of the same size, of the same year, from the same artist, and you would think those two paintings will have a similar value, and the logic is correct. However, if one of them has a black cat in it, and it's a painting by, I don't know, Diego Rivera, for instance, who is a Latin American artist, because of, people don't like black cats in paintings. So there are silly issues like that can make a painting worth a lot less than what you thought it should otherwise be worth. And other risk, well, of course, all the markets can collapse, and although we think that the correlation between art and equities is, they're not very correlated. In the last crisis, we saw that everything was correlated. A very big risk, and this is something that we've been watching very carefully, is entitlement. Same thing as real estate. When you buy a piece of art, you can, for instance, you can find and it's happened to us. We were buying it was a Rousseau painting in Paris. This was last year, and there were some red flags, some things that we thought, well, I think there's something wrong with this painting, something wrong with this transaction, something's happening here. Well, we found out that the painting was coming from a couple that were divorcing. So the husband was trying to sell the painting behind the back of his wife. If we would have bought that painting, we would have had definitely a big problem on the entitlement process, because chances are that the wife would have made a claim against the painting and she would have won. We also have a lot of works have been restituted from looted works from World War II. There's databases where you can check if a painting has been stolen, and there's the FBI, the Art Laws Register, and other archives that show you whether a painting has been stolen or not. And finally, one thing that we're starting to use, and we're just about to insure our entire fund, there's a company there that's called Iris Title Insurance. So we insure the artwork against defective title the same way you would insure a piece of real estate. And I think that gives a lot of peace of mind to the investors, knowing that in the event that there's a claim for that artwork, we are covered by an insurance policy. And that insurance policy costs us anywhere between 1% and 3%. But it's definitely worth it. First, in terms of our auditors like it, because we have our official appraisers, plus then we have title insurance on each one of the paintings. Then all they need to do is just come and inspect the inventory and know that everything's there. So it adds a lot to the transparency of the holdings of the fund.
If I wanted to invest in either diamonds or art or wine, and wanted to do it as an investment, not as a hobby, what are ways available today to, institutional investors? They can look at your funds like them. But if you're an individual investor, are there ways that you could approach this asset class?
as an individual investor, you need to, there's no shortcut. You need to spend an awful amount of time studying and understanding art as an asset. Like I said, it has an emotional component that is very difficult to value. There's the very difficult penetration. If you want to do it on your own, you're definitely going to need an expert to start guiding you on the process, and then you can fly on your own. It's like flying an airplane. You can't start flying an airplane even if you read a manual. You need an instructor. Once you've done a few flights and then you feel comfortable, you can start flying on your own, you can. So in the art market, I'd say you definitely need a good, very, very, very good guidance.